When it comes to investing, there are some very basic fundamentals that we're going to be covering in today's video. There is a very systematic approach in a step-by-step guide that we're going to be going to maximize the investment strategies that you have and make sure that you're ready for retirement and you're saving for anything that you need to. Let's go ahead and get into this. But before we do, go ahead and subscribe to the channel. We are really doing incredible with the financial education. Looking at the debt-free journey, we are continuing it step by step and day by day. So the first one that we look at is starting early. This is one of the absolute most fundamental when it comes to the step-by-step investing process. Is the earlier that you start investing, it is going to be a game changer. If you start a new job and you set that essentially contribution to a certain amount, or at least getting the match, which we'll look at, it is going to be a game changer on how you're building. Essentially, what you want to do, big picture thinking on the investment frontier, is setting aside 15% of your income. And again, we're going to break it down exactly how that should be invested in this video. And it really does systematically make sense when you look at financial education and counseling, when you look at investment advisors, when you look at the investing world itself. They're on the same page for a majority when it comes to the strategy behind the step-by-step investing and how you can really build up a multitude and a big factor and a big growth factor, honestly, of compounding interest through the years. So when you think systematically, let's say from 18 to 22, you start a job, you put $200 away a month and you're putting it into, let's say, a high yield account that you're getting a decent return. It is invested $200 a month. You're putting $2,600 away a year. In 28 years, you will have $1.1 million. So again, think if you start at 22, at the age of 50, you'll have $1.1 million in retirement by only saving $200, which is pretty incredible to think. Now, of course, for a majority of people, when it comes to the average balances, it is crazy, crazy low. When you look, even people, let's say age 50 to 60, you're talking about $150,000 towards retirement. That is already saved. Even when you look at individuals getting to that age of 65, when they're hitting those retirement years, it is roughly $175,000 that they have saved for retirement. Because what we normally see is the 20s, not a lot of investment, not a lot of savings really going on during those 20s. It is really a time where, you're earning not as much money as you're going to, as you start getting more set in your career, finishing school, everything of that nature. But you get to the point where 30s, you might start investing, you might start saving some. When we see about the 35 to 40, that is usually the time when people start turning on all of the 401ks, start doing all the investment strategies, and have an idea or a thought around retirement, which you're talking 35 to 40, you're about 10 to 15 years behind the curve if you would have just started with the compounding rate off of the bat, which can make an absolute game-changing difference when you think about the compounding interest that you're going to get. Because again, in just thinking, if you start at 22 and you save until you're 65, you're going to have $4 to $5 million in a retirement account by saving a pretty minimal amount. Again, just because of the compounding factor that we do have in there. Now, when we start off at this second step, this is the match. So when you look at your 401k, and I know this is kind of opposite of what Dave Ramsey says, but a lot of people are on the same page with this second step. First one, of course, saving early. Second step, getting your 401k match in its entirety. Doesn't matter if it's 4% that they match, 6%, if it's 50 cents on a dollar, anything that you're putting in there for a match, you are getting a 100% return. There is nowhere that I'm aware of, short of some hitting the lotto or some wild crypto investment, that you're going to be seeing a 100% return into your 401k account because of the match. Again, if you're putting in, let's say, $100 a paycheck, they're matching $100 a paycheck. Second paycheck, you're putting in 100, they're matching 100. You're putting $400 away into a 401k every single month, which is kind of incredible to think how much and how fast that is going to compound. Even in the scenario that we used, if you're putting away $50, they're matching your $50. You're putting that $100 in there a paycheck. Again, it is going to make a big difference because you're still going to be at that $200 a month, where in the course of those 28 years, you're going to see $1.1 million in an account, as long as you're getting a pretty decent return on how it's invested. Definitely, guys, you can't leave money on the table. And I cannot stress how absolutely pivotal this is when it comes to investing. Because again, you come out of college, let's say you're 22, 23, which normal people are, you start a career, let's say you're making 30 to 50,000 a year coming out of college. If you're putting away a very small amount and getting that company match for wherever you're working, it is going to compile, it is going to see the compounding effect, which we know is the eighth wonder of the world. And the growth factor in there is going to be massive over the multitude of years that you're going to be investing. Now, the next one we look at on number 3, once we start early with the investing, second one, of course, is that 401k match. And the third one is paying down your debt. Now, this, of course, is really the second most expensive thing that you are going to really deal with when it comes to investing and when it comes to being able to create wealth itself is debt. When you look at high interest debt, so your 401k match, you're getting 100% return. Let's say you're putting in 4%, 4% is being matched. Boom, you get your 100% return. If it goes up, again, exponentially, that's going to make a big difference. Now, when it comes to paying down debt, especially starting with that high interest debt, most of the credit cards right now are running about 22 to 24% interest. And again, when you think of investment accounts, when you think of the S&P 500, the VOO, the VUG, the SCHD, regardless of the ETFs that you love to invest in, it's not going to be anywhere close to an annual return of that 22 to 24% that you're paying in credit card debt, which is the reason why it is really a big focus. Now, again, just kind of changing it up a little bit from the Dave Ramsey baby steps, because I advise, and I've always said this, invest into the 401k for the match first, then focus 100% onto paying down that debt. And guess what? Once you eliminate that debt, once it is paid down, you suddenly have a paycheck, and a big chunk of that paycheck that was going to the liabilities, that was going to the debt, is now yours and is now yours to keep. Because we've always said, you get a paycheck, you pay all of your expenses. What you have left over is the amount that you're actually going to keep. So the big thing is, if you're making 50,000 and you're paying 50,000, there's nothing left over. We see the exact same thing when individuals get to 100,000. They're spending 100,000, if not more. Again, they're going back to zero. Now, it's a big game changer. If you're making 50,000, you're spending 40,000, all of a sudden you have $10,000 to invest, to pay down debt, to save, to build that emergency fund. There are so many things that you can do when you have disposable income that is going to be available to build up those retirement funds and make sure that whatever your financial goals are, if it's going to school, if it's planning for your kids' college, getting married, going on vacation, there are so many things in life that I want you to be able to do without having to debt finance everything. I really strongly recommend, when it comes to a lot of things and it comes to debt specifically, when it comes to unsecured debt, it is very expensive. I see individuals in my personal and professional career that come into, go on vacation. They're borrowing $10,000, $15,000 to go on vacation, $25,000 for a wedding. They're borrowing it for 5, 6, 7 years. So for a multitude of years, when they start off together with another individual or even going on vacation with their family, they're paying it for a multitude of years. And most of the time that debt literally just gets rolled over, because if you're borrowing 15,000 for a wedding, chances are you're not even going to make 15 grand on a majority of weddings these days, which means after your big day, and congratulations, you are stuck with a big debt bill together to start off your new life together. That is not the way that we wanted to start, guys. Focusing everything, especially if you're going from single income to a dual income or more than one income, it can be an absolute game changer. Now, for a majority of people that are having issues or having hurdles paying down debt, there's a lot of different ways that you can really look at this. Is one, with the budgeting method, how can you cut out some of the expenses? What can you eliminate? What can you get cheaper? This might be mortgages. This might be homes. It might be insurance. It might be even cutting down on going out to eat. Finding ways to be a little bit more frugal in your budget makes a really big difference, and it can go a very, very long way when it comes to the longevity of paying down the debt. Now, in addition, there's always the option of the side hustle, the side gig, the work on the side, the second job, to really bring in a little bit of income, even if it is for a very short amount of time. If you're doing YouTube, if you're doing Fiverr, if you're doing DoorDash, delivery services, whatever it may be, you got yourself into a debt situation where you accumulated too much debt. It is up to you to get out, and really, honestly, getting out as fast as possible. If you're focusing all of your time and effort to the elimination of that debt, it is going to be gone faster than you think. And guess what? Once the debt is gone, you don't have to deal with it anymore. And it's up to you to keep and stay debt free, which of course is entirely on you. Now, the next one we look at, once we've got our 401k match, we've actually went through, we paid down and paid off all of our debt, which even with the debt factor, do not include the mortgage. I don't include the mortgage when it comes to the investment strategy, just for the simple fact that mortgages are so low. I know we do want to be entirely debt-free, which it will come with time. And ultimately, once you get a retirement account or an investment account to the point that it is large enough to go ahead and knock out the mortgage in one fell swoop, the mortgage still does have a lot of benefit. And of course, keeping in mind what your interests are in a lot of other things. When you look at auto loans right now, they're about 7% normally, which means you're paying a pretty high premium if you have an auto loan at a much higher rate. For majority of Americans, I believe it was around 60% of Americans refinanced during the COVID time when rates were literally nothing. I know us personally, we have 2.5% on a 30-year, which is kind of crazy to think, but to rush to pay off that 2.5%, to me, financial counseling doesn't really seem to make sense when we can have some pretty good returns when it comes to the market. Now, what we get into number 4 is maxing out the Roth IRA. Now, when we talked about the 401k a little earlier, I believe this is the first year, guys, that individuals are going to be able to have a Roth 401k. Majority of places, including my employer, did not offer a Roth 401k. It was not an option. It was traditional only. The matching was traditional. That was it. It was just one and done. You put in, you got your matching. It was all traditional. At this point, I believe the 401k providers, if they choose to, can have a Roth option, which I always recommend 10 times more than the traditional option. Essentially, big picture, the way to think about it is if you're putting money into a 401k and it's going to a traditional 401k, you have a tax, essentially you're lowering your taxable income in the year you make the contribution, but all you're doing is kicking that tax can right down the road. So what happens is you might get a little bit of benefit now, you might get your 5 or 10% right now, but when you look at the exponential growth factor, when it comes to building up, 20, 30, 40 years of those retirement, it is going to be astronomical how much money you're going to have to pay when you start, again, kicking that tax burden down the road with the investment accounts. When they start compounding exponentially, the government will get a lot more money from you during retirement, even though your tax brackets are a little bit lower, which again, that is not guaranteed at all, guys. Tax brackets have changed through the years, which means you could be looking at lowering your tax liability today. With it in the future, tax brackets could be a lot higher than they are today, or could be a lot different than what we see them today. With the Roth option in both the 401k and the IRA, they are tax-free. You have already paid the taxes up front, which is the way you should do this. Again, so when you see the exponential growth, when you start seeing that compounding going on 10, 20, 30 years down the road, the taxes are already paid. The money is yours in its entirety. And also with the Roth options, you don't have to take required minimum distributions, meaning that if you do not use the money for anything, the money can actually sit there and it will grow tax-free, which again, anything that you don't have to pay taxes on or pay less taxes on, I highly, highly recommend. So maxing out the Roth. Now, the Roth contributions, of course, have a far lower amount that you can actually contribute, which personally, I don't agree with at all. I feel like the government at this point needs to do anything they can to get more money and really beef up and bulk up these retirement accounts, because a majority of individuals are not going to be able to retire. And a lot of people that are in retirement just relying on Social Security. Social Security was designed to replace 40% of your income, which means if you don't have anything, including pensions, investment accounts, 401ks, IRAs, that can replace the other 60% of income that Social Security is not providing. You're going to be very, very much struggling when it comes to these retirement years, because you didn't set aside enough to essentially retire on for the supplement when it comes to the Social Security. So again, we've maxed out our 401k match at our 4%. We paid down our debt, everything but the mortgage. We maxed out our Roth IRA, which I believe is the $7,000 for 2023. So that is completely maxed out. And then we look at the next one, which this isn't going to apply to everyone, but this is talking about maxing out the HSA. Now, this, in my opinion, it is a triple tax advantage account, which is kind of crazy to say. Again, when we kind of break down the taxes, when you put money into your HSA, you get a tax, essentially a tax credit, or you pay less in taxes, very similar to what we have in the 401k. The money in the HSA can grow completely tax free as long as the money is used for qualified health expenses. You do not pay tax either. That is the triple tax advantage of an HSA account, which honestly is an absolute game changer. They estimate during retirement, the average from 65 till the time a person passes is roughly $5,000 to $7,000 a year in health costs. You're talking about doctors, you're talking about copays, you're looking at dentists, you're looking at, even your eyeglasses, anything that is medical related, especially prescriptions, are going to be covered by the HSA account. So essentially, if you can bulk up and you can build up your HSA account, maxing out your contributions every single year, when you get to retirement, again, you're not going to be reliant on Social Security to cover all of those healthcare costs. You're not going to be reliant on the 401k and the IRA money to go ahead and cover all of those health expenses, dental expenses, whatever it may be, because you have an account that is already sitting stocked full of money that is growing exponentially because it is invested, that is completely tax-free for you. That is right, guys. As we continue our journey down here, we're looking at a lot of tax advantage, definitely a step-by-step tutorial of how you should invest. And honestly, I follow this. If you follow this, you are going to see the absolute benefit and seeing how far down this list you can really go. So again, employer match, we're looking at 4%. We paid down the debt. We got that done. Max out the $7,000 in our IRA. And then, of course, we max out the HSA in its entirety. Again, making a really big difference when you look at having that money, setting it aside for a life's unexpected expenses and also for retirement. So once you went through and finished all 5 of these steps, we are actually circling back and looking at maxing out the 401k. So the first time we did this in step 2, we were looking at making contributions into that 401k to at least, at the bare minimum, get the match. That is something, again, you're giving away free money if you're not getting that match. If your company offers a match, I really, really strongly advise you as a financial counselor to get the match out of there. The match, even though it might be a small proportion, at least you're putting something, that 2%, 4%, whatever they match, at least you're contributing to your retirement, guys. It is free money that they are giving you with the match. It is employers that are providing these 401k plans. And of course, they essentially, once upon a time, they had pension plans, which everyone was very reliant on those pension plans. Since a majority of the pension plans, which I believe it was around 14%, last time that I read that 14% of Americans are still eligible for a pension plan. A majority of the ones, even in this area, have went to the 401k plans, meaning the pension plans are slowly being phased out because pension plans are very expensive on the employer side. And of course, employers looking to essentially cut costs to save money made a big difference, cut out all of those pension plans. Maxing out the 401k. Now, very similar to what we talked about with the IRA, the 401k has a much higher limit. That is the big thing to remember, where the IRA was roughly 7,000. The 401k, I believe right now is 23,000 for 2023 for the contribution. And I believe it's going up just a little bit, which it does kind of systematically go up with inflation. They raise it a little, usually about $500 is what we normally see. So if you're going back, so we went through here, again, we maxed out our 401k match, we paid down our debt, maxed out the IRA, maxed out the HSA. Now we're circling back to hit that 23,000 if you still have money left into that 401k, which again is going to make a game changer because we've capped all of our retirement accounts at this point. And again, this is being very, very frugal when it comes to the amount of money that you're spending and where you're putting the money in. Systematically makes the most sense to get the most kind of bang for your buck, especially when it comes to the elimination of debt, as long as you're going ahead and you're putting that minimum into the contribution and the matching contribution within the 401k. And after, if you're still a baller, you still got money out there and you're looking what to do with it, this is So looking at the brokerage accounts, looking at crypto accounts, looking at real estate, because we have a really big chunk of money in that 401k. We have money in the IRA. We have money in those HSAs. We maxed out the 401k. If you still have any money left at that point, this is where you can go in and you can invest kind of on your own, because we know when it comes to 401ks, when it comes to IRAs, they're pretty limited for the majority of employers on what you can actually invest the money in. So when you're looking at what your employer offers, it actually might make a little bit more sense to take money outside of your 401k. And this is going to be really at your discretion under the advisement of financial advisors. If your company doesn't offer a good 401k plan or a good investment strategy, essentially within that 401k plan, it might be a lot better for you to take the money elsewhere, invest it into other avenues, just because you're not going to see the return on the portfolio. Now, of course, you also do have to take a couple other things when you think about the 401k plan. What are the management fees? What are the investment fees? You have to wholeheartedly sit down with your 401k provider, know the in and outs of the plan before you know exactly where you're going to be putting all that money. Because I've seen some 401k plans that are very, very bad. Even having a match, it was very expensive to hold the funds. And also remember, when it comes to 401ks, if you have an old employer, if you have money elsewhere, if you have money sitting in an IRA at a bank or a credit union, a financial institution, guys, I cannot stress enough. I have a link down below for M1 Finance. You can roll your investment accounts into an M1 account, whether it is an IRA. You can roll it over to M1 Finance. And with M1 Finance, you can invest it in the market. Your money has to be invested in the market. From a big picture, being able to grow. If you have it at an institution, we've seen IRAs at financial institutions, the Chase, Bank of America, Wells Fargo, things of that nature, that are paying like a 0.03, a 0.3 for a retirement account, meaning that every year that you're keeping money in that retirement account, you are losing a ton of money because inflation is literally eating up the dollars that you have in that account, meaning that you're not going to see the growth factor. You have to make sure, depending on your age, that you're taking a little bit more risk with the portfolio, that it's invested in the market, and you're seeing growth and you're seeing returns. Now, of course, if you're getting closer to retirement, my personal advice on this aspect is take a portion of it. So again, thinking of, okay, you're going up, you're 62, you're getting to 65. You still want to see a considerable amount of growth in that portfolio. So let's say, just for instance, you get to the age of 65, you have $1 million in your portfolio. Even if you took, let's say, 300,000-400,000 of that, put it into something that is going to grow, investing it in the market, kept the rest of it even in bonds, possibly safe, CDs, things like that. You're going to still have a big chunk that has an opportunity to grow over a multitude of years, because again, when you get to retirement with $1 million portfolio, chances are you're not going to be spending that probably in the next 5, 10, maybe even 15 years during retirement. So you might have another decade or two for those funds to grow even after your retirement, which means you could be leaving a much larger nest egg to your children, to your heirs, to your grandchildren, where when you actually leave everything to them, it could make a really, really big difference on how effective and exactly how much money that you do have in there. So let's just go ahead and recap this, guys, before we're done. If you got some questions, definitely drop them in the chat and we will cover them. But we started with number one, starting early. The earlier that you start investing, it gives you the ability to not only get the compounding aspect, but you also started off on the right step with having the mentality and the thought of a saver, of an investor. You can do this with as little as you have. It might be $20 to start, $50, $100, whatever it is. You need to start really starting saving today. A lot of people ask, when should I start saving for retirement? The answer, of course, from the financial aspect is yesterday. When it comes to saving, when it comes to big picture, having enough money for retirement, you absolutely should have started saving yesterday if you're asking that question. And again, if you're starting at 18, when you start a first job, if you start investing, start putting money away, even putting it into an investment account, whether it be Webull, whether it be investing, that is really the big thing. Now, of course, the second one we looked at is the 401k match. So if your company does provide a 401k, you want to match it up to whatever they're offering. 2%, 4%, 6%, 50 cents on the dollar, up to 2,000. Whatever it is, I've seen a multitude of 401k plans, but they are literally giving you 100% return on the match that you're going. So talk to your HR department, make sure that you're set up, and make sure you know what your 401k plan is not only offering as a match, but also where it is invested. That is imperative when it comes to what it is invested in. You have to make sure that you do have that. Third one we looked at, paying down your debt. Again, very important when you look at credit card debt, when you look at auto loans, unsecured debt, you want to pay off everything except the mortgage. The mortgage is going to be the very, very last thing that we look at when you're looking at paying down debt, which is not included in this step. Step number 4, maxing out that IRA. Now, of course, if you can get Roth 401k, if you can get a Roth IRA, I advise the Roth options because you're going to have the essentially paying your taxes up front. It's going to be after tax dollars that you're putting in there. But when you get the growth over a multitude of years, it is going to be a game changer. Number 5, we looked at maxing out the HSA. Now, again, when it comes to the HSA account, you want to max this out because when you need money, you're essentially prepaying for your health, for your medical, or for your medical, for your dental, and for your vision. You are prepaying everything in this HSA. Also, it is invested for a majority of companies. So as long as it's invested in growing, you want to make sure you're taking full advantage of the triple advantage account. Then we look circling right back around to maxing out that 401k. Contributions need to be at the maximum at this point because the more you stock in there, and again, when we think of the scenario of the $200 invested a month over 28 years, if you're putting 23K into a 401k every year, your exponential curve for the growth and for the compounding is just going to be absolute insanity. If you look at an investment calculator and see exactly where it's going to land, it's super interesting to see, again, if you're maxing out and putting money into a multitude of accounts, just how fast it grows and how fast it does grow with the compounding aspect. And then once all of this is done, guys, this is where you're looking at those brokerage accounts, looking at possibly putting a couple percent, 3 to 5% in crypto, even doing real estate investing, looking at some REITs, just to really round out the portfolio because you have money in a 401k, you have it into a Roth IRA, we have it in the HSA. This could be, again, just some more money that you're kind of setting aside in a taxable brokerage account, but also looking at a percentage. And I know with all of the ETFs around Bitcoin and how they've been performing lately, they're saying that roughly, 2 to 5% for a majority of individuals should be invested in cryptocurrency for the long-term growth. Then, of course, REITs have a very good return in real estate themselves. Personally, I like the investment into residential real estate. I really worry, and I'm a little bit concerned when it comes to the commercial real estate, just because of the market that we're in. And since COVID, honestly, it completely changed the work from home. A lot of companies are not bringing people back in a full-time capacity, which means we actually don't have the ability, or a lot of commercial properties are kind of left open. The industrial side is doing well as far as production, as far as importing. The industrial side, again, is doing well. Residential is. Commercial, I can see, and it's trying to catch up a little bit. But overall, the commercial real estate really kind of leaves a question mark for me personally. But that's just my opinion on exactly how we should go ahead and do this. So guys, that is going to do it for today's video. Thank you guys for joining me for the live stream. I love doing these live streams. We're going to try to get a little bit more consistency on getting these within the channel. But definitely, if you follow this methodology, if you follow it to a T like I do, only thing that we have left personally is the home, which within the next couple of years, it is going to be paid off in its entirety. Having a couple multi-million-dollar accounts within the investment realm is definitely what we're looking to build and what we're looking to essentially grow to. But we are absolutely getting there little by little. Every contribution that we're making to the 401ks, what we're putting in brokerage accounts, what we did with paying off and eliminating all of our debt in the entirety while we're maxing out those HSAs, it is a really, really solid game plan. So again, guys, that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.